Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Australia's banks have had a good run recently, outperforming the market by about 20% since bottoming mid last year or a bit later than that. But will it continue, and do some of the banks offer better value for investors than others? Remember, this is general information only, and you should always seek professional advice before making investment decisions. Dougal Maple-Brown is the head of Australian Value Equities at Maple-Brown Abbot. Dougal, welcome to Fear and Greed.
Thank you, Sean.
Can you give us a potted history over the last, or maybe 6 to 12 months, why the banks fell, really? And then I think it was late October, early November, they sort of that bottom there. But since then, they've really run hard. Just why did they fall? But particularly, why have they done so well since then?
Yeah, thanks, Sean. As you alluded to in the intro, a bit over a year ago, there was maximum fear for the banks. So you recall then there was a mortgage war, so a pricing war. And there are also people pretty concerned about the outlook for the economy and whether the landing would be a soft landing or a hard landing. Now, some of those fears never eventuated, particularly on the hard landing scenario. So that's the first reason. And the second reason, frankly, a year ago is that at least the banks that we owned, the cheaper ones were particularly inexpensive. So you could buy a year ago ANZ Westpac on roughly book value, 10 times forward earnings, which were pretty decent valuations in our view. Last October, when the outlook for interest rates in particular changed, the outlook for the economy improved, the banks have been re-rated. So it's not really an earnings story, it's more of a re-rating. And again, those cheaper banks that I referred to a minute ago no longer trade on book value. They're now trading on 1.2, 1.3 times, and indeed on a PE basis from about 10 times to 13 or 14 times.
When you talk about a PE, so price to earnings basis, you're valuing the bank on forward earnings. What is typical for one of the big banks? So you said it's gone from 10 to 13. 10's cheap. Is 13 normal? The only way you can say normal is compare it to historical periods, I suppose.
Yeah, excellent question, Sean. Yeah, we would argue that 13 times is about normal for an Australian bank. And to give you the scale, and this is only in recent times, and even today, at the top of the tree, you've got Commonwealth Bank, which trades over 20 times forward earnings. You've got National Australia Bank, depending on the day of the week, trading on about 15 or 16 times. And as I alluded to earlier, ANZ and Westpac on 13 or 14 times.
Why does Commonwealth Bank trade so much? Why is it valued so much higher than the others?
Yeah, Sean, I think I could probably write a small thesis on that, and my guess, frankly, is no better than anyone else in the market. The Commonwealth is the most valued, as in highly rated, big bank in the entire world. So that's not just in the Australian sense; that's in a global sense. It's a $150 billion plus company trading on, let's say, over 20 times forward earnings. Lots of theories, but of course, no one really knows. Obviously, a lot of the shareholders in Commonwealth Bank are the original mums and dads who were lucky enough to get the stock in one of 3 IPOs, I think it was back in the 90s, at single-digit prices for a stock which now trades over $100. So you can see there'd be some tax paid on if they were to sell.
True. So where we stand today, will it continue? Will these now the market has come off a little over the past couple of days, but you still have banks close to record or multi-year highs. Can it continue for the big four? Let's start with them.
Yeah, Sean, again, that's the million-dollar question we have to deal with every day. I will distinguish here between absolute and relative valuations. So as we've discussed, I think the absolute valuations are pushing the top end of the range. Unfortunately, in my game, and I'm an Aussie equity investor, and I have to be fully invested, so I have to compare it to what else is in the market. And in our view, banks, at least the cheaper ones, still look relatively good value compared to some very high-priced industrials. So again, using those PE multiples I referred to a minute ago, industrial stocks on average in Australia are trading on about 24 times forward earnings. That's the average. So you can understand why many are trading well above that. So to compare to that, a bank on 13 or 14 times still looks okay to us relative to some what we would say are very expensive industrial stocks.
Okay, so primarily there we're talking about Westpac and ANZ. And my understanding has always been, but please correct me if I'm wrong here, it's because banks are highly indebted. Is that why they're not valued as high as other industrials?
Yeah, that's the primary reason, is that they've got more leverage and hence more risk. And we've seen that, again, in my investing lifetime several times, but most noticeably in 2008 and the global financial crisis. And the other issue I think people would say today is that they've got less growth. We're a mature economy. The big four dominate the markets. There's not much market share they can take apart from each other. So yes, higher leverage and lower growth than the average industrial stock.
Yeah, you alluded to that at the beginning of this conversation. They're not exactly growth stocks, are they?
No. And again, on my numbers and indeed on the market's numbers, the banks have got very limited, if any, growth, depending on your assumptions over the next few years. Credit growth low, net interest margin, which effectively their profit margin, keeps getting compressed. Costs are going up more than normal with inflation, and most people have bad debts increasing as we come from pretty good conditions to less good conditions somewhere. It's very hard to tell when over the forecast period. So most people have got bank earnings flat. Having said that, you pick up good dividends, and apart from ANZ, they're largely fully franked. So you can still get a gross dividend yield of 8 or 9%, which again isn't a bad return to us in the current environment.
Stay with me, Dougal. We'll be back in a minute. I'm speaking to Dougal Maple-Brown, Head of Australian Value Equities at Maple-Brown Abbot. What about international investors? And now something that I think you were quoted in one of the media outlets talking about flood of money, or not a flood of money, but money from offshore coming into the Australian banks.
Yeah, there's definitely been some of that, Sean. That's one of those theories which has been a bit of press about. Very hard to prove. So the theory, and I think there's some weight to it. China's been a disaster, obviously. So people who have mandates investing in Asia and including Australia are taking money out of China. I think that's fairly obvious. Where do they put it? The other big markets are India and Australia. If you're taking money out of China because you're concerned about China and you put it into Australia, you probably don't want to put it into our resource companies, which, remember, are about a third of our market, because the resource stocks, the iron ore producers, the energy stocks are effectively a leverage play on China. So if you're not going to put it into resource stocks, what do you look for? And the big liquid banks would be a reasonable place to put your money. And I suspect that's where some of that Chinese investing money has ended up.
Okay, so sort of wrapping up the banks, your preferred option at the moment would be Westpac and ANZ over the other two, I'm assuming, or certainly over Commonwealth Bank. Is it something that you would buy more into, or is it something just given valuations? You said that they're kind of normal valuations. I'm not sure whether that's a fair valuation or not. Is it something, though, that you're probably not going to go too much further into given their prices?
Absolutely, Sean. I don't want to misrepresent that. They've had a good run. We've done very well out of them. But no, we're not buying banks today. And at the margin, we're probably trimming a few of them as the prices go up, which we should as good contrarian value investors.
You mentioned industrials. We're just changing tack here a bit. What like industrials? It's a broad church, I think, the term industrials.
Yep.
What areas within industrials do you think of interest? I mean, I don't mind if we go stock specific, or more the themes in industrials.
Yeah, and just for your viewers, I mean, the Aussie equity market is roughly 20% banks, 30% resources, and 50% industrials. And as you alluded to, it's a broad church, everything from airlines to supermarkets to telecommunications companies. I think the big switch for us over the last couple of years, if you go back a few years, people were talking about the expensive defensives. And again, these are generalizations.
Mm-hmm.
Today we are finding more value in businesses which are defensive. So things like the supermarkets, things like the liquor retailers, than some of the cyclicals which have run very hard. So that's been the big change over the last couple of years. In a relative sense, we're finding better value in some of the defensive names, not because we're terrified about the economy rolling over, but we're just finding better value support in those names.
Do you think the market generally, sort of on that basis, do you think the market has become a little overexcited about what the economy is doing? I mean, this soft landing scenario sounds good, and certainly earnings forecasts, well, based on the share market, people are confident about earnings going forward. What you just said then, it just made me think, maybe like it's being a bit defensive suggests that maybe we've gone a bit too far on that scenario.
Yeah, I think we've got a little bit too far on that one, but I'll bring it back to the banks again. As I've already said, the bank earnings forecasts are flat. So I think that they're sensible forecasts.
Yeah.
Some of the cyclical industrials have got earnings growing upwards and onwards forever, and we all know that's very hard to do. So at this point in the cycle, yes, people tend to extrapolate the good times forever, and that definitely is reflected in some stocks, clearly not stocks we like.
Dougal, thank you for talking to Fear and Greed.
Pleasure, Sean. Thank you for having me.
That was Dougal Maple-Brown, Head of Australian Value Equities at Maple-Brown Abbot. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.